Hello, my name's Fiona. Again, this is just one of those videos where I'm making this for me and posting this for me so I can listen to it as I go to sleep. But if it's helpful for you, all the better. So this is for CMA Exam Part 2, and let's see, I'm starting with, this is based on the Gleim units that I made flashcards on, but this is Unit 8, and we'll see how many units I get done in this video. And, well, this first card, I'm not sure what unit it is, but I just kind of put it in Unit 8, that's when I wrote it down in my notebook. So, alright. To process or not to process. Joint costs are irrelevant at the split off point. The minimum unit selling price after further processing that we will want equals the opportunity cost plus further processing cost per unit. So that's also equal to the unit price at split off plus the additional cost to process. So again, to process or not to process, well, the minimum unit selling price that we would accept for further processing would be the unit price at split off plus the additional cost to process. That's opportunity cost, because that unit price, that would be what we would, the money we would get for that unit if we didn't spend that additional money on processing it. So, I don't know, maybe you're making a mint, right? You could get, this is Mr. Binks. You spent 50 cents manufacturing a mint, and you could sell that mint for $2. Well, that's great. But you could also process that mint even further and make it into not just a mint, but a little candy cane shaped mint. And that cost to do that will cost you another $1. So it costs 50 cents to make the mint, another $1 to make it into a candy cane, and you could sell it, if you just left it as a mint, you could sell it at $2, or if you process it further, what's the minimum price that you need to sell it at for it to be worth processing it further? Well, because the 50 cents it costs to make the original mint, you've already made the mint, right? That cost is irrelevant now. Like, you can't change that. You're literally holding an Altoid right now, and you're deciding whether to sell that Altoid to someone or make it into a candy cane shaped Altoid. So it doesn't matter, the cost that you paid to make the Altoid doesn't matter now. So that's a sunk cost. So that's why it's the $1 that you could sell the Altoid for right now, or plus the additional cost to process that extra, $2 to sell the Altoid now, plus the additional cost to process, which I said was $1 to make it candy cane shaped. So the minimum price you'd be willing to accept if you processed it further into like a candy cane shaped Altoid would be $3. That original 50 cents doesn't matter. It's sunk. Alright, so now on to the real Unit 8. Sorry, something's in my eye. The real Unit 8 content. And this is like foreign currency rate stuff. So this is definitely what I struggle with. So hopefully this video helps me. Okay, so let's assume dollar value X equals euro value Y. Okay? So when dollar value X equals euro value Y, the spot rate for a euro is X dollars. The spot rate for a dollar is euro 1 over Y. Okay? So let's go back. If we assume dollars equals dollar value, let's say $1 equals 1.2 euros, okay? The X and the Y. The spot rate for 1 euro is, the spot rate for, whatever a euro would be. So if we reverse this around and said, euro X equals dollar $y, then that would be X. But the spot rate for a dollar in terms of euros would be that 1 over 1.2 euros. The 30-day forward rate, so for a euro, would be dollar value Z, totally different number. Let's say that's $2. So the 30-day forward rate for a dollar is also going to be 1 over Z euros. So totally, different letter. 1 over C euros. So totally different euro value as well, but still kind of the same relationship for forward rate. Okay, but in any case, when the dollar forward rate is less than the dollar spot rate, you have a forward discount, okay? So if forward is less than spot, forward discount. When forward is greater than spot, forward premium. Which makes sense, right? If the spot rate is worth more now than what, like let's say it was a stock, right? If the stock is worth more now than it will be in 30 days, then that's, not really helpful for you, right? But that's helpful for whoever's buying the stock from you. But if that stock is worth more later than it is now, that's a premium. That's helpful for you when you sell the stock. And that's kind of, me just trying to analogize things, because that's just how things make sense to me. So again, forward premium discount also could be just called the annual effect, right? Oh yeah, so okay, calculating the forward premium or discount or annual effect equals the forward rate minus the spot rate over the spot rate, all of that times days in year over days in forward period. So let me do that again. Annual effect, forward premium or discount, whatever it is, it doesn't matter because we're using the forward rate, spot rate, days in year, days in forward period. So, parentheses, forward rate minus spot rate divided by spot rate, end parentheses, times parentheses, days in year divided by days in forward period, end parentheses. So if we did an example, well, it's hard to, I'm not going to come up with a forward rate and spot rate for you, but let's say 360 days in year, 30-day forward rate, like they say 30-day forward rate is blank. Then we have forward rate minus spot rate over spot rate times 360 divided by 30. And that's the annual effect of the forward premium or discount. So a forward rate contract. This minimizes risk because the firm knows what amount it can exchange currency for at a date in the future. A receivable hedge, so by selling forwards, we receive, so by selling forwards, the dollars received would be the forward rate times X foreign currency units. So, okay, selling forwards, that's a receivable hedge. Buying foreign currency forwards is a payable hedge. And when you do that, you receive the dollars locked in would be a forward rate times X foreign currency units bought. Okay, so a payable hedge is when we buy a foreign currency forward, but a receivable hedge is when we sell a foreign currency forward. Was it good to hedge? How do you know? So, using yen, Japanese yen, for example. So you calculate, oh my gosh. Sorry, it is like 9 p.m. for me, so I am brain dead. In order to calculate whether it was good to hedge or not, if we use whatever foreign currency, but I'm just going to say yen, you do yen to be received later times the forward rate minus parentheses yen to be received later times the future spot rate. Okay, so we're comparing what the forward rate is, so like the predicted future spot rate times the actual future spot rate. So we're to determine if the hedge was worth it, we're now in the future is now the present, okay? Like we've completed the hedge, and now we're seeing if it was worth it. So you can't determine if it was worth it while you're hedging, because you're not going to have that future spot rate. Okay, so one more time, calculating if it was good to hedge, that's yen to be received later times the forward rate minus yen to be received later times the future spot rate. So I guess the second part, yen to be received later, really it's yen that was received, because now the future is the present. So, but if let's see, if that amount we just calculate is positive, then yes, the hedge was worth it, because the yen to be received later times the forward rate, like that was more than what the future actually held. So that meant with that forward rate, it was more, it just was more. But if that above that we calculated is negative, then no, it wasn't worth it. But hedging is always good for risk, especially with foreign currency, because there's so much that influences the rates and whether they're going to appreciate or depreciate, like trade, imports and exports, inflation, like the relationships between countries. There's so much that goes into it that it is kind of just always good to hedge. But if you want to know if it worked out or not, then you do, one more time, yen to be received later times the forward rate minus yen received later times that future spot rate. Okay, so calculating the cost of imports or exports if the rates appreciate or depreciate and there's inflation. There's two different ways you can do it. So it's the foreign inflation rate divided by the domestic depreciation or appreciation, so -1. So I took a pause there, so I'm going to say this one more time. Foreign inflation rate divided by domestic depreciation, that fraction -1. Or you could also do $1 times parentheses 1 plus the inflation rate over times, I don't know if that's supposed to be a dollar or euro. So maybe the second formula is not that good for me. But 1 times 1 plus foreign inflation rate divided by 1 euro times parentheses 1 minus depreciation rate, and you're still subtracting 1 from that fraction. Okay, and to review again, if the dollar forward is less than the dollar spot, you have a forward discount. If the dollar forward is greater than the dollar spot, you have a forward premium. Okay, steps for effective interest rate on loan denominated in foreign currency. There's 4 steps. So first, you have to calculate the amount borrowed in the borrower's domestic currency. So that's yen borrowed, or sorry, I have euros on here, but it's euro Y, so I went with yen. I'm going to restart this. Steps for calculating the effective interest rate on loan denominated in a foreign currency. So this is like if I borrowed money from Ukrainian bank or something, just a bank somewhere else in the world rather than here in the US. So first you have to calculate the amount borrowed in the borrower's domestic currency. So you take the I am gonna stick with yen. It's one less syllable. Okay, so the amount borrowed in borrower's domestic currency, the yen amount borrowed times the spot rate. So that's gonna equal that yen Y times dollar X. Step 2, we're going to convert that amount borrowed in borrower's domestic currency into domestic at the spot rate on the maturity date. Step 3, which is calculating the maturity amount of loan in foreign currency. That's that yen amount borrowed times, parentheses, 1 plus the interest rate on the loan, end parentheses. Step 4, this is the effective interest rate on loan denominated in, or just effective interest, effective interest rate. Effective interest rate on loan denominated in foreign currency, that's step 2 minus step 1 divided by step 1, where the spot rate equals $X to 1 yen. And just a reminder of what those steps are. So the effective interest rate on loan denominated in foreign currency, that's the amount borrowed in borrower's domestic currency converted to the domestic currency at the spot rate on maturity date minus the amount borrowed in borrower's domestic currency divided by the amount borrowed in borrower's domestic currency. And to put the last step in another way, effective interest rate on loan denominated in foreign currency, that is, let's see. So the yen borrowed times the spot rate converted into the domestic rate at the spot rate on maturity date minus yen borrowed times spot rate divided by yen borrowed times spot rate. Whew, that was a lot. International business expansion, also known as direct foreign investment. Reasons to do it. There's kind of two different like general reasons why, or not two general reasons why, but two types of reasons why you would want to do it, right? So why would you want to do direct foreign investment or international business expansion? Your reasons are either going to be revenue oriented or cost oriented. So if some revenue oriented interests, reasons are seeking new markets or avoiding trade restrictions. Cost-oriented reasons are seeking cheaper inputs or seeking favorable exchange rates. So let's see. I'll give some examples, right? For international business expansion or direct foreign investment, if you're seeking new markets, like your product, let's say you're selling masks, right? And this is pre-COVID. There's not, unless you're in the medical field, masks were kind of unheard of in the US before COVID, but I know, I'm familiar because I watched a Shark Tank pitch on this. Like, there was a big market for face masks, like, in Asia, especially China pre-COVID, just because of the air quality, like, if you're in a city. So, if you're trying to sell, like, cute face masks in the US pre-COVID, and no one seems interested in the US, revenue-oriented reason for direct foreign investment would be to try to sell those masks in China instead, where they'll probably be more popular. Another revenue-oriented reason, avoiding trade restrictions. So maybe you're selling, with all the tariffs in the US right now, let's say you're China, right? You're China, you had like a tariff that was over 100% from the US, you probably might not want to sell to the US anymore. You probably might want to sell elsewhere so you can just avoid that tariff. Now, some let's go through the cost-oriented reasons for international business expansion or direct foreign investment. Seeking cheaper inputs. You're a company in the US, you make a product. Manufacturing is expensive here because that's, just definitely the wages and benefits are pretty expensive here. But if you just, bought or rented a plant in China, you could surely probably make the product a lot cheaper, which is what a lot of companies do. The other cost-oriented reason, seeking favorable exchange rates. So, let's say this will take me a second to think about, okay? But the euro is appreciated compared to the dollar right now, right? So you are manufacturing and selling in Europe, but it's kind of more expensive to buy the inputs in Europe rather than if you bought them from America, because your euro has more purchasing power in America than it does in Europe. But things to keep in mind for international business expansion or direct foreign investment: this increases exposure to political risk, exchange rate risk, and exchange rate fluctuations. So, I mean, there's some good pros to direct foreign investment, but there's risk. Synergy. So this is calculated by the value of the combined firm minus the sum of values of the separate firms before they combined. And it's found via a capital budgeting technique of discounted cash flow analysis. So, but essentially, let's see, who is GameStop? So recently, GameStop was trying to buy eBay, right? If you want to calculate synergy for that, let's say the deal went through and then they combined. Synergy would be the value of now combined GameStop and eBay minus the sum of, the value of GameStop before it acquired eBay and the sum of eBay before it was acquired in that hypothetical scenario, but I'm pretty sure that deal didn't go through. Merger. So speaking of synergy, it's a business combination where the acquiring firm, the acquiring firm absorbs a second firm, or however many firms, and the acquiring firm remains in business as a combination of the merged firms. In a merger, the acquiring firm generally keeps its name and identity. In a merger, the shareholders of each firm generally vote to approve the merger. So, like, most of the time, you do have to get that shareholder approval. The merger may result in the acquisition of stock. I know a way that companies get around having to deal with the shareholder vote if they don't think the shareholders will go for it, or if they're just trying to take advantage of an opportunity and bypass something that would slow them down. Like sometimes firms, instead of doing a merger, which is like, an agreement to merge, just propose a deal to the company to just buy all their stock. You don't need shareholder approval to do that because that's an investment rather than a merger. All right, functional currency. That's the currency of the primary economic environment the entity operates in. That's normally where the firm primarily generates and spends cash. Okay, so let's say you're a U.S. firm, but you own the manufacturing plant in China, and you also have offices in Europe because you sell the Altoid. This is back to the Altoid example. You're selling the Altoids in Europe and the U.S., but you make them in China. Well, let's say your primary market's the U.S., then the U.S. dollar is going to be your functional currency, not the euro. The euro is like Europe was your secondary market, so the euro is not the functional currency. I mean, the functional currency doesn't have to be the same as what your financial statements are reported as, actually. Those can be different things, but you still have to note in the financial statements what the functional currency is. All right, on to study unit 9, UCM. That's the contribution margin per unit. So it kind of bugs me that the acronym for contribution margin per unit is UCM, but that's just the way it is. So you could also think of it as unit contribution margin. So anyway, contribution margin per unit is the unit price minus the unit variable cost. So again, contribution margin in general, that's those net revenues minus the COGS, that's contribution margin. So same thing here for the unit. You're just doing it per each unit rather than in total. So contribution margin per unit, UCM, unit price minus unit variable costs. Now the contribution margin ratio, This is called CMR, okay? Contribution margin ratio, there's several ways to calculate it. One is those, and again, contribution margin ratio, this is the ratio in general. It doesn't have to be like per unit, but some of these formulas do use that. I always like rant before I start a formula, right as I say I'm about to start it. Okay. Contribution margin ratio equals sales minus variable costs divided by sales, which is, total contribution margin divided by total sales. You can also find the contribution margin ratio by doing 1 minus the ratio of variable costs to sales, or 1 minus the percentage of average variable costs. You can also find the contribution margin ratio by taking the UCM, contribution margin per unit, divided by sales per unit. Target income in units. You can calculate this by taking fixed costs plus the target net income divided by the UCM, contribution margin per unit. So target income, target sales, that's fixed costs plus the target net income divided by UCM, contribution margin per unit. Now to find target net income in units, you do fixed costs. Okay, so this is the numerator, okay? Fixed costs plus, parentheses, target net income over 1 minus tax rate. All of that divided by UCM, contribution margin per unit. So let's go through that again. Target net income in units. Numerator, fixed costs plus, parentheses, target net income over 1 minus the tax rate. Denominator, UCM. Break-even point in sales dollars, where operating income so the break-even point is where operating income equals 0, or expenses equals revenues, or contribution margin equals fixed costs, okay? So this is where literally breaking even. We go from negative to 0 before we go positive. We're looking at how much, how many sales dollar, how much we need to sell in terms of sales dollars in order to break even and hit that 0 threshold. This can be found by taking total fixed costs divided by the contribution margin ratio, CMR. Or if there's a product mix, right, so there's multiple products, because, that's not very often there's a firm that sells only one thing. You would find the break-even point in sales dollars by taking still total fixed costs divided by the weighted average contribution margin ratio. So you find the contribution margin ratio of each product, and you multiply each one times its percentage of the product mix. And again, the contribution margin ratio is sales minus variable cost divided by sales. You can also find the break-even point in sales dollars by doing total variable costs plus total fixed costs, or fixed costs divided by the UCM, contribution margin per unit. Now the break-even point in units is found by, excuse me. Okay. I'm gonna fix my note card here because I had said, where's my pen? I guess I'll use a different color. Sorry, I needed to do that. Let me start again with, you're going to see why I did that in a second. Break-even point in sales dollars is total fixed costs divided by contribution margin ratio, weighted average or not, or total variable costs plus total fixed costs. Break-even point sales dollars is not fixed cost divided by the UCM, because that is actually break-even point in units. I accidentally put it on both. So the break-even point in units is fixed costs divided by the unit contribution margin. And I'll explain why that is, because That's, remember what the unit contribution margin, UCM, is. That's unit price minus unit variable cost. So you're getting, you know, what you're going to make. Sorry, I just got a notification. You're going to get what you make per unit, ignoring the fixed costs, but you're putting that into fixed costs to see how many units you need to sell to get to 0. And remember, fixed costs generally, that's fixed manufacturing overhead and fixed marketing, like really anything that just says fixed in front of it, that's going to go into fixed costs. So again, break-even point in units, fixed costs divided by UCM. All right, UCM in units, so contribution margin per unit in units. There's like several ways to find this. This is why it's a different, card. Total fixed costs divided by the break-even point in units. And remember, the break-even point in units is fixed costs divided by UCM. So when you have total fixed costs divided by fixed costs divided by UCM, what you really get is total fixed costs times UCM over total fixed costs. So you're left with UCM. And remember, UCM is unit price minus unit variable costs. Multi-product break-even analysis. So, like before, we talked about like that break-even point with multiple products. Now we're doing I'm talking you through those steps actually. Sorry, my parents are texting me. I'm doing this all in one take. But now I'm going to actually walk you through the steps for doing that break-even analysis with multiple products. So, first step, like I said, you need that sales mix percentage for each of the products. And then, step 2, you find the UCM, contribution margin per unit, for each product. And that's unit selling price minus unit variable costs. You then multiply, step 3, each UCM by each sales mix percentage. So basically, you're going to have, What is this? Break-even CMR. Sales dollars would be CMR. Okay. I just wanted to clarify because this multi-product break-even analysis, the way I have it written, is for in units, okay? So, but I'm going to go back through the steps again. I'll say if you want to do in units, it's UCM. And if you want to do for sales dollars, it's CMR, okay? So, multi-product break-even analysis for sales dollars you need or units you need. So, still the first step is find that sales mix percentage for all the products. And then step 2, you need to find either the contribution margin ratio if you're trying to find sales needed for break even, or you need to find the UCM, contribution margin per unit, if you're trying to find the units needed for break even. And then you multiply what you found for each one of those by that sales mix percentage. And so now you have a weighted average. Like they're all the sum, each of those is now weighted by that sales mix percentage. So the next thing you do is you sum each of those, and now you have the total weighted average, either contribution margin ratio if you're trying to get break even in sales dollars, or weighted average UCM if you're trying to get break even in units. And so then you use that to find the overall break even point, which again is you take total fixed costs and you divide it by that weighted average, whatever you just found. And then last thing, you just multiply the overall break even by each product mix. Multi-product break even point in units, like I just went through this, but again, that's total fixed cost divided by weighted average UCM, unit contribution margin. multi-product break-even point in sales dollars, total fixed cost divided by weighted average CMR, contribution margin ratio, which again, remember, contribution margin ratio is the total contribution margin divided by total sales. Or you could like do it by the product, right? Like the UCM divided by the price. That would work as well. If you need to find that selling price per unit, okay, that's break-even units divided by total fixed costs, and parentheses, minus unit variable costs. And remember, break-even units was total fixed costs divided by UCM. So what you really have is total fixed costs over UCM times 1 over fixed costs. So the total fixed cost goes away. So now you have 1 over UCM minus unit variable costs. Projected profit at X sales. So remember the contribution margin ratio since contribution margin ratio is used for a break-even point in dollars, because that's fixed cost divided by CMR, we're then going to solve for the projected profit, okay? So break-even point in dollars, fixed cost divided by CMR. So that means CMR equals fixed cost divided by break-even point in dollars. And thus, X sales times CMR equals CM. So projected profit equals CM minus fixed costs. Margin of safety, that's the difference. That's budgeted sales minus break-even sales. So margin of safety, that's like, you know, what you expect to sell and you're kind of hoping to sell, minus what you actually need to break even and not lose money on that engagement. Now the margin of safety ratio is the margin of safety divided by budgeted sales. And so to break that down, margin of safety, the numerator is budgeted sales minus break-even sales, that divided by budgeted sales. And remember, break-even sales is fixed costs divided by UCM or CMR. So to break down margin of safety ratio even further, it's budgeted sales minus parentheses fixed costs over UCM, CMR, all over budgeted sales. So let me say that one more time. Margin of safety ratio equals the margin of safety divided by budgeted sales, which means, and remember, margin of safety, we just said is budgeted sales minus break-even sales. So budgeted sales minus fixed costs over UCM, CMR over budgeted sales equals that margin of safety ratio. The contribution margin income statement is just 5 little steps. So contribution margin income statement, you just use 5 fingers, okay? Sales minus variable expenses equals the contribution margin, minus fixed expenses equals operating income. And on a contribution margin income statement, you have those 5 fingers, so 5 rows, and there's 3 columns. There's a total, there's per unit, and then there's the percentages. So, and the percentages are at those sums, or at where we sum the things, right? So you won't really have a percentage, the percentage is in like the ratios, right? So we've got the contribution margin ratio and then operating income ratio. Okay. I just did units 8 and 9, and I'm feeling pretty good, so I think I'll stop there and do the next couple units in a separate video. Thank you.